Hello and welcome to the only finance channel designed to put you to sleep. At some point you've probably felt like you should be doing something with your money, investing it, growing it, making it work. But every time you tried to figure out how, you ended up more confused than when you started. Too many options, too many opinions, too much noise. Tonight we cut through all of it. And if you're watching this during the day, save it to your watch later playlist and come back tonight. This just works better in the dark when your brain stops fighting and starts actually absorbing things. Trust me on that one. For everyone already in bed, perfect. Get comfortable. Tonight is about investing, not the complicated version that the industry wants you to believe in, the simple version that the evidence actually supports. We are going to go through how index funds work and why they beat most professionals most of the time. Dollar cost averaging and why the boring automatic approach consistently outperforms the exciting active one. How to build a simple portfolio from scratch, what diversification actually means and what it does not, when and why to rebalance, and the correct order of operations for everything. Let's go. And actually, before we dive in, if you're already enjoying this, subscribing genuinely helps a new channel like this grow. It takes 2 seconds and it means I can keep making these. No pressure, just appreciate the support if you do. Part 1. Index funds vs actively managed. The data is brutal. Let me start with something that should change how you think about investing entirely, because once you understand it clearly, most of the complexity dissolves. There are 2 ways to invest in the stock market. The first is to pick individual stocks or funds that you believe will do better than the market. The second is to simply own the whole market, every company in proportion to its size, and accept whatever return the market delivers. The first approach is called active investing. The second is called passive or index investing. And the argument for the second approach is not philosophical or aesthetic. It is purely empirical. The data is overwhelming, consistent across every market studied, and has held up over every time period examined. Here is the core finding. Over any 10-year period, approximately 80 to 90% of actively managed funds run by professional investors, with teams of analysts, sophisticated data tools, years of experience, and significant resources, underperformed their benchmark index. The index that just automatically buys everything and does nothing beats the human professionals with all their advantages most of the time by a meaningful margin. This has been studied exhaustively. Spiva, the S&P indices versus active scorecard, publishes this data every year. The numbers vary slightly depending on the time period and the category of fund, but the direction is always the same. Active management underperforms passive indexing the vast majority of the time over long periods. And the underperformance compounds. If an actively managed fund underperforms by 1 percentage point per year, over 30 years, that 1 percentage point becomes the difference between having significantly more or significantly less money at the end. Small annual differences, compounded over decades, become enormous differences in outcomes. The reason this happens is not that fund managers are incompetent. It is that markets are efficient in a very specific sense, When millions of sophisticated, informed investors are all analyzing the same companies, the same data, the same earnings reports, the same management teams, the information is incorporated into prices very quickly. The moment something is generally known, it is generally priced in. Finding genuinely undervalued opportunities, companies that are worth more than their current price, requires finding something that everyone else has missed. And in a market with this many participants and this much information, that is genuinely hard. Not impossible, but hard enough that most professionals cannot do it consistently. And then there are fees. The actively managed fund charges more, typically 1 to 2% per year, sometimes more, for the privilege of its professional management. The index fund charges almost nothing, typically 0.1 to 0.2%. That fee difference, compounding over decades, is significant even before you account for performance. After you account for the fact that the active fund typically underperforms the index on a gross basis as well as on a net basis, the case for active management becomes very difficult to sustain. There is a small percentage of fund managers who genuinely outperform over long periods. The problem is identifying them in advance. The managers who have outperformed over the last 5 years are not reliably the managers who will outperform over the next 5 years. Past outperformance is a very poor predictor of future outperformance. So even if you believe that genuine alpha, genuine edge over the market exists for some managers, identifying which managers have it before the fact is essentially impossible for a retail investor. And by the time a manager's track record is strong enough to be convincing, much of the easy outperformance may already be behind them. The practical conclusion from all of this evidence is straightforward. For most investors, in most circumstances, a low-cost index fund is the best available investment product. Not because it is exciting, not because it requires skill, but because the evidence consistently shows it produces better outcomes than the alternative over long periods. And in investing, outcomes are the only thing that matters. Part 2. Dollar cost averaging, the lazy strategy that consistently works. Let me describe a strategy that requires almost no skill, no market knowledge, no timing ability, and no ongoing attention. A strategy that has been studied extensively and that consistently produces better outcomes than the more sophisticated approaches most people attempt. A strategy so simple that most financial media barely mentions it, because there is nothing to explain, nothing to optimize, nothing to make a course about. Dollar cost averaging, or euro cost averaging, depending on where you are. The concept is simple. Instead of investing a large amount all at once, you invest a fixed amount at regular intervals. Every month, every week, whatever frequency makes sense for your situation. You invest the same amount regardless of whether the market is up or down, regardless of whether the news is good or bad, regardless of how you feel about the economy. The amount goes in automatically on schedule and you ignore everything else. Why does this work? And why does it tend to work better than trying to time the market? Trying to invest more when prices are low and less when prices are high. The first reason is mathematical. When you invest a fixed amount, you automatically buy more shares when prices are low and fewer shares when prices are high. If you invest 100 euros per month and the price of your index ETF is 50 euros per share, you buy 2 shares. If next month the price drops to 25 euros, you buy 4 shares. Your fixed contribution goes further when prices are low, which means your average cost per share over time tends to be lower than the average price over the same period. This is called the dollar cost averaging benefit, and it is a genuine mathematical advantage. The second reason is behavioral. The biggest enemy of good investment outcomes is not market risk. It is investor behavior. The tendency to buy enthusiastically when markets are rising, when prices are high, and to sell fearfully when markets are falling, when prices are low. This behavior, buying high and selling low, systematically destroys returns, and it is driven by emotion, by loss aversion, by FOMO, by all the psychological mechanisms we discussed in a previous video. Dollar cost averaging largely neutralizes these behavioral tendencies by removing the decision. There is no monthly decision about whether now is a good time to invest. The investment happens automatically. The market is up this month. The investment happens. The market is down 30%. The investment still happens, automatically buying more shares at lower prices. The emotional signals that would otherwise distort your behavior have no mechanism through which to act. The third reason is practical. Most people do not have a large lump sum to invest all at once. They have income that arrives monthly. Dollar cost averaging is simply the natural way to invest income as it arrives. Contribute a fixed percentage of each paycheck to your investment account automatically and continue building your position over time. It requires no timing, no analysis, no ongoing attention. Set it up once and it runs. There is a version of this argument that is sometimes raised against dollar cost averaging. If you have a large lump sum available and you invest it all at once, and the market subsequently goes up, you'll have more money than if you had spread the investment over 12 months. This is mathematically true. In a rising market, earlier investment is better. Studies suggest that lump sum investing outperforms dollar cost averaging roughly 2/3 of the time. But this argument misses the point for most people. Most people do not have a large lump sum sitting uninvested. They have monthly income. Dollar cost averaging is not a choice between lump sum and installments. It is the natural rhythm of investing income as it arrives. And even for the 1/3 of scenarios where the market falls after the lump sum investment, dollar cost averaging provides meaningful protection against the worst timing. The practical implementation of dollar cost averaging is also the simplest possible financial habit. You open an investment account, you set up a standing order from your bank account to your investment account for a fixed amount triggered on the day after your paycheck arrives. You buy your chosen index ETF on that day. You repeat indefinitely. You do not check the market. You do not adjust the amount based on news. You do not pause when things seem uncertain. You contribute and you wait. That is it. That is the strategy. And it is genuinely one of the most effective approaches to wealth building available to ordinary people. PATR3: How to build a simple portfolio from scratch. Here is where most investing content becomes unnecessarily complicated. There are thousands of ETFs available, dozens of asset classes, endless variations of portfolio construction theory, and a financial industry that has a strong incentive to make you believe that complexity is necessary for good outcomes. It is not. The evidence consistently shows that simple, low-cost, broadly diversified portfolios produce outcomes that match or exceed more complex alternatives, net of fees. And the simpler the portfolio, The less opportunity for behavioral errors, the lower the ongoing decision burden and the lower the cost. Let me walk you through building a simple portfolio from scratch, practically step by step. Step 1. Decide your asset allocation. Asset allocation means the split between different types of investments. The most fundamental split is between equities, stocks, and bonds. Equities offer higher expected returns over long periods and more short-term volatility. Bonds offer lower expected returns and less volatility. Your allocation between the two should reflect your time horizon and your capacity to tolerate short-term losses without making behavioral errors. A simple rule of thumb that many financial advisors use is to subtract your age from 100 or from 110 or 120 for more aggressive approaches and hold that percentage in equities with the remainder in bonds. So at 30 years old, 100 minus 30 equals 70% in equities and 30% in bonds. At 50, 50% in each. This is a rough heuristic, not a precise recommendation, and your specific circumstances matter, but it gives you a starting point. Step 2. Choose your equity exposure. For the equity portion of your portfolio, the evidence strongly favors a globally diversified index. Not just the US market, not just your home country, the whole world. There are index ETFs that track the global equity market, every publicly traded company in the world in proportion to its market capitalization. These give you exposure to thousands of companies across dozens of countries. The most commonly referenced global index is the MSCI World, which covers developed markets, or the MSCI All Country World Index, which includes emerging markets as well. One or two ETFs tracking a broad global index can be sufficient for the entire equity portion of a simple portfolio. You do not need to separately buy US ETFs, European ETFs, Asian ETFs, sector ETFs, and theme ETFs. A single global index covers all of it in appropriate proportions automatically. Step 3. Choose your bond exposure. For the bond portion, government bonds from developed economies are the most commonly used. A global government bond ETF, or a combination of home country and international government bond ETFs, provides the stability component of the portfolio. Bonds tend to go down less than equities during market crashes, which gives you something to hold on to psychologically, and if you rebalance, something to sell to buy more equities at lower prices during downturns. Step 4. Choose your platform. You need a brokerage account to buy ETFs. The key criteria are low fees. Look for platforms with low or zero trading commissions and low account fees, and access to the ETFs you want. Many online brokers now offer commission-free trading on major ETFs. The account type matters too. In many countries, there are tax-advantaged account structures for long-term investing that should be used first. Step 5. Set up automatic contributions. As we discussed in the dollar cost averaging section, automate the contributions so they happen without your ongoing attention. Fixed amount, fixed day, indefinitely. Step 6. Set a rebalancing schedule and ignore everything else. We will discuss rebalancing in a moment. But the key point is that between scheduled rebalancing reviews, you should be doing nothing. Not checking daily, not adjusting based on news, not switching ETFs when something seems more attractive. Nothing. The portfolio runs itself. That is the portfolio. For most people, most of the time, this is sufficient. A global equity index ETF, a bond index ETF, in proportions reflecting your time horizon. purchased automatically every month, rebalanced annually. It is not exciting. It does not require ongoing attention. It does not require market knowledge or forecasting ability, but it works. And working is what matters. Part 4. Diversification. What it actually means and what it doesn't. Diversification is one of the most frequently used words in investing and one of the most frequently misunderstood. Most people have a general sense that it means not putting all your eggs in one basket. That is correct as far as it goes. But the full picture of what diversification does and does not achieve is worth understanding clearly. Diversification is the practice of spreading investments across many different assets, such that the performance of any individual asset has limited impact on the overall portfolio. When you own 500 companies instead of one, the bankruptcy of one company, even a large one, represents a small fraction of your portfolio rather than a catastrophic loss. The mathematical basis for diversification is correlation. When two assets are perfectly correlated, they always move in the same direction by the same amount. Combining them provides no diversification benefit. When two assets are negatively correlated, they tend to move in opposite directions. Combining them can actually reduce overall volatility below either individual asset. Most real-world assets fall somewhere in between. They are positively correlated to some degree, but not perfectly so. Combining them reduces volatility without necessarily reducing expected return. This is sometimes described as the only free lunch in investing. By combining assets that are not perfectly correlated, you can reduce risk without sacrificing expected return. You get better risk-adjusted outcomes from a diversified portfolio than from any single asset. This is mathematically demonstrable and is the foundational insight behind modern portfolio theory. But diversification has important limits that are frequently overlooked. The first limit is that diversification within equities does not protect against market-wide downturns. In a significant market crash, 2008 being the clearest recent example, correlations between different equity asset classes increased dramatically. Asset classes that normally behave independently start moving together. US stocks fall, European stocks fall, Asian stocks fall, large cap stocks fall. The diversification that helps in normal times provides much less protection in the extreme events where protection is most needed. This is why the conventional wisdom to hold bonds alongside equities exists. During most major equity market downturns, government bonds from developed economies have provided at least partial protection. Their prices have held up or increased while equities fell. The equity bond diversification has historically provided more genuine protection in downturns than equity-only diversification. The second limit is geographic diversification and home country bias. Many investors significantly overweight the home country equity market relative to its share of the global market. A British investor might hold mostly UK equities, a French investor mostly French equities. This is called home country bias, and it is typically not justified by the evidence. The UK represents roughly 3 to 4% of global equity market capitalization. A portfolio that is 80% UK equities is massively overweight a 3 to 4% slice of the global market. The same logic applies to any home country. Global diversification, owning the global market in proportion to market capitalization, eliminates home country bias and provides the broadest possible spread of equity risk. The third limit is the illusion of diversification through multiplication. Many investors believe that owning 10 different funds is more diversified than owning one. This is sometimes true and sometimes completely false, depending on what the 10 funds hold. 10 different US large cap funds might all hold essentially the same 500 companies in slightly different proportions, providing almost no additional diversification over a single S&P 500 index fund. One global equity index fund, by contrast, might hold thousands of companies across dozens of countries, providing genuine diversification in a single product. More funds is not the same as more diversification. What matters is the underlying holdings and their correlations, not the number of fund wrappers. Part 5. Rebalancing when and why. When you set up a portfolio with a target allocation, say 70% equities and 30% bonds, the market immediately begins moving your actual allocation away from your target. If equities perform well, they become a larger percentage of your portfolio than you intended. If bonds perform poorly, they become a smaller percentage. Over time, without intervention, your actual allocation can drift significantly from your target. Rebalancing is the process of periodically returning your portfolio to its target allocation. You sell the assets that have grown beyond their target proportion and buy more of the assets that have fallen below their target proportion. Buy low, sell high, enforced mechanically by the rebalancing process. Why does rebalancing matter? There are two reasons. The first is risk management. If your portfolio drifts from 70 to 90% equities over several years of good equity performance, you have taken on significantly more risk than you intended. A subsequent equity market downturn will hurt you more than it would have if you had maintained your target allocation. Rebalancing keeps your actual risk exposure aligned with your intended risk exposure. The second is behavioral. Rebalancing forces you to sell assets that have done well and buy assets that have done poorly. This is the opposite of what most investors naturally want to do. The psychology of recent performance is to buy more of what has been going up and avoid what has been going down. Rebalancing mechanically enforces the discipline of buying low and selling high, overriding the behavioral impulses that typically produce the opposite. How often should you rebalance? The research on optimal rebalancing frequency is mixed. Rebalancing too frequently generates transaction costs and tax events without meaningful benefit. Rebalancing too infrequently allows significant drift. Annual rebalancing is the most commonly recommended approach for most investors. Once a year, you review your allocation and bring it back to target if it has drifted beyond a certain threshold. A common approach is threshold-based rebalancing. You only rebalance when your allocation has drifted more than 5 percentage points from your target. So if your target is 70% equities, and your actual allocation has become 73% equities, you do nothing. If it has become 76% equities, you rebalance. This approach reduces transaction costs while still keeping your risk exposure reasonably aligned with your intentions. There is also a practical way to rebalance without selling anything, which can be tax efficient. Instead of selling overperforming assets, you simply direct new contributions to the underperforming asset class until the allocation is restored. If equities have grown too large a share of your portfolio, you stop contributing to the equity fund for a period, and contribute entirely to the bond fund until the proportions are back to target. This achieves the same rebalancing outcome without triggering a taxable event. The psychological challenge of rebalancing is worth acknowledging. Selling your best performing assets and buying your worst performing ones feels counterintuitive. If equities have had a spectacular year and bonds have been flat, selling some equities and buying more bonds feels like the wrong direction. But that is exactly what the target allocation demands. And the research consistently show that maintaining target allocation through disciplined rebalancing produces better risk-adjusted outcomes than letting the portfolio drift with market movements. Part 6. The real order of operations. This is the section that I think matters most for anyone who is just starting out. Because the question of which investment to make is actually much less important than the question of what to do in what order. And getting the order wrong is expensive in ways that are not always obvious. Let me lay out the correct sequence clearly. The first priority is always the emergency fund before you invest a single euro, before you open a brokerage account, before you buy your first ETF. 3 to 6 months of living expenses in cash in a separate savings account, immediately accessible. We have covered this in detail in a previous video. The emergency fund is not optional, and it is not the first thing you do after you get other things in order. It is literally the first thing. The second priority is high interest debt. If you are carrying consumer debt, credit cards at 20%, personal loans at 15%, buy now, pay later balances. Paying these off is the highest return, lowest risk investment available to you. A guaranteed 20% return is better than any market investment on a risk-adjusted basis. Pay off all high interest debt before investing. The threshold question is where to draw the line between high interest debt that should be paid off before investing and lower interest debt that can coexist with investing. A common rule is anything above 5 or 6% interests should be paid off before investing, because the expected long-term investment return of around 7% does not provide enough cushion above that rate to justify carrying the debt while also investing. The third priority is tax-advantaged accounts. In most countries, there are account structures that allow investment gains to grow tax-free or tax-deferred. In France, the PEA shelters equity gains from income tax after a 5-year holding period. In the UK, the ISA allows completely tax-free investment gains and withdrawals. In the US, the Roth IRA allows after-tax contributions to grow and be withdrawn completely tax-free. These accounts should be maximized before investing in taxable accounts because the tax benefit compounds over time and represents a significant advantage that is freely available. Many people do not fully use their available tax-advantaged allowances, not because they are unaware of them, but because the process of setting them up requires some initial effort and the benefit is invisible in the short term. The fourth priority is employer matching. If your employer offers a pension or retirement contribution match, they contribute an additional amount for each euro you contribute, up to a limit. This is effectively free money and should be captured in full before doing anything else. A 50% employer match is a guaranteed 50% return on your contribution before any investment performance. There is no better available return. The fifth priority is investing beyond the above. Once your emergency fund is in place, your high interest debt is gone, your employer match is captured, and your tax-advantaged allowances are utilized, you invest additional savings in low-cost index ETFs in a taxable brokerage account. At this point, the main variables are your asset allocation and your contribution consistency. The product choice is relatively straightforward given the evidence on index investing. This order matters because deviating from it is costly. Investing before paying off credit card debt at 20% means simultaneously earning an expected 7% and paying 20%, a net negative 13%. Investing in a taxable account before maximizing a tax-advantaged account means paying tax on gains that you did not have to pay. Not capturing employer matching contributions means leaving free money on the table. Each deviation from the correct order has a real financial cost that compounds over time. The order is not complicated. Emergency fund, high interest debt, employer match, tax-advantaged accounts, then invest. And now let me go deeper on some things we have touched but not fully explored. Part 7. Why most people get investing wrong and what actually changes behavior. Understanding the correct approach to investing is one thing. Actually implementing it and maintaining it over decades is something entirely different. And the gap between knowing and doing is where most investment returns are lost. The research on this is sobering. Studies that compare the returns of investment funds to the returns actually earned by investors in those funds consistently find a significant gap. The fund might return 8% per year, but the average investor in that fund earned 5 or 6% because they bought after strong performance and sold during downturns. They were in the fund for the good periods less fully and experienced more of the bad periods. This gap between what the investment earns and what the investor earns is sometimes called the behavior gap, and it represents real money. Across a 30-year investment horizon, the behavior gap can reduce your final wealth by 30, 40, 50% compared to what it would have been if you had simply bought and held. What causes the behavior gap? Almost everything we discussed in the Psychology of Money video. Loss aversion makes you sell during downturns. FOMO makes you buy during peaks. Overconfidence makes you trade more than you should. Social proof makes you chase whatever everyone else is currently excited about. Present bias makes you delay contributions. Narrative drives you toward thematic investments at exactly the wrong time. The correct investing strategy, index funds, dollar cost averaging, rebalancing, patience, is the direct counter to all of these behavioral tendencies. It removes decisions from the moments when decisions are most likely to be wrong. It automates the behaviors that are hard to maintain through willpower. And it provides a simple, clear framework that does not require ongoing analysis or judgment. But knowing this does not automatically produce good behavior. You need a system that makes the good behavior the default and the bad behavior the active choice. Automated monthly contributions that happen regardless of market conditions. A simple portfolio that does not require ongoing attention. A written investment policy that you agree to when calm, that you can refer to when the market is crashing and every instinct is telling you to do something. The system does not guarantee good outcomes. Nothing does in investing, but it dramatically improves the probability of good behavior. And good behavior over long periods is the primary determinant of good investment outcomes. What the evidence actually says about stock picking and why it matters for you. There is a version of the active versus passive debate that is often presented as a matter of opinion or style. Some people prefer active investing, some prefer passive. Both are legitimate approaches. This framing is misleading. The evidence on this question is not ambiguous or balanced. It is overwhelming in one direction, and understanding why matters for the decisions you make with your own money. The S&P SPIV report, which compares actively managed funds to their benchmark indices, has been published since 2002. Every single year, in every single major market studied, the majority of actively managed funds underperform their benchmark index over 10-year periods. Not most years. Every year. Not in most markets. Every market. The consistency of this finding across 2 decades, across developed and emerging markets, across different fund categories, is the strongest possible signal in empirical finance. The argument that is sometimes made in response is survivorship bias. Perhaps the funds that underperformed have been closed or merged, making the survivors look better than the average active fund really is. This is a genuine concern, and the SPIVA methodology attempts to control for it. But even accounting for survivorship bias, the conclusion holds. Active management underperforms passive indexing for the majority of funds over long periods. Another argument is that some fund managers genuinely outperform. This is true. A minority of fund managers produce sustained outperformance over long periods. The problem is identifying them in advance. The standard test for this: do funds that outperformed in one 5-year period outperform in the subsequent 5-year period, produces results barely better than chance. Past outperformance is a very weak predictor of future outperformance. And since you can only invest going forward, not backward, the historical track record of a fund tells you much less about future performance than most investors assume. There is also the question of fees. An actively managed fund that produces gross returns equal to the index still underperforms the index net of fees. So to justify its fees, an active fund needs to outperform the index by at least the fee differential on a gross basis. Given that the majority of active funds underperform on a gross basis, and then additionally charge fees that further erode returns, the net result is systematically worse than the passive alternative for most investors most of the time. Why does this matter for you specifically? Because if you are currently paying 1 to 2% per year in fund fees, believing that you are receiving commensurately better investment management in return, the evidence says you probably are not. Switching to a low-cost index alternative with fees below 0.3% would, based on the historical evidence, most likely improve your outcomes without requiring any additional skill, analysis, or effort on your part. That is a meaningful financial improvement available to almost anyone who is currently invested in actively managed funds for almost no effort, and the compounding benefit over decades is very large. Part 8. The Psychology of Simple Investing. Why doing nothing is hard. Here is something that sounds straightforward but turns out to be genuinely difficult in practice. The correct investing strategy for most people involves doing almost nothing almost all of the time. Set up automatic contributions. Buy a global index ETF, rebalance once a year, leave it alone. The difficulty is not intellectual. Understanding this approach takes about 15 minutes. The difficulty is psychological, because the financial environment you live in, the financial media, the social conversations about investing, the product offerings of the financial industry, is designed around activity, around doing things, around the idea that investing is an ongoing, intellectually engaging pursuit that requires constant attention and decision-making. The financial media needs content. Financial advisors need to justify their fees. The brokerage industry profits from transactions. None of these actors benefit from telling you to set up a monthly standing order, buy a global index ETF, and ignore everything else for 30 years. So they do not tell you that. Instead, they generate a constant stream of analysis, commentary, recommendations, and predictions that collectively create the impression that active attention is necessary and valuable. Most of it is not. The analysis does not improve your outcomes. The predictions are not more accurate than chance over meaningful periods. The recommendations reflect the incentives of the recommenders as much as the merits of the recommendation. The activity creates the feeling of doing something useful, while typically delivering worse results than doing nothing. This is not a criticism of any individual in the financial industry. Most are genuinely trying to be helpful within the constraints of their business model. It is a structural observation about how the incentives of the industry align and how they differ from the incentives of individual investors. The industry profits from activity. Individual investors profit from patience. These are not the same thing. Understanding this structural misalignment makes it easier to resist the pull toward activity. When you see a compelling investment thesis, you can ask, whose interests are served by this recommendation? When you feel the urge to adjust your portfolio in response to news, you can ask, what is the evidence that this adjustment will improve my outcomes? The answers are almost always stabilizing. And the payoff for maintaining the discipline of simplicity and patience is not small. The behavior gap, the difference between fund returns and investor returns caused by poorly timed buying and selling, can amount to 2 or 3 percentage points per year. Over 30 years, that difference represents a very large proportion of your final wealth. Avoiding the behavior gap is worth more in absolute terms than finding a slightly better investment product. And avoiding the behavior gap is achieved through simplicity, automation, and the deliberate practice of doing nothing when the urge to act is strong. PAT 9. The complete cost picture. Everything investing actually costs you. We have talked about management fees, the expense ratio that funds charge annually. But the full cost of investing is broader than just the expense ratio, and understanding all the components helps you make better decisions about where and how to invest. The expense ratio is the most visible cost and usually the largest for long-term index investors. For a low-cost global index ETF, this is typically 0.1 to 0.3% per year. This fee compounds over time. On a €100,000 portfolio, 0.2% is €200 per year, compounding on an ever larger base. Transaction costs are the second component. Every time you buy or sell an ETF, you may pay a commission to your broker and a small bid-ask spread, the difference between the price at which the market will sell to you and the price at which it will buy from you. For liquid, large ETFs traded on major exchanges, the bid-ask spread is typically very small. Many online brokers now offer commission-free trading on major ETFs. But if you are trading frequently or buying less liquid products, transaction costs can be meaningful. Currency costs arise when you buy ETFs denominated in a different currency from your home currency. Your broker converts your euros to dollars to buy a US listed ETF, charging a currency conversion fee in the process. This can be managed by choosing ETFs listed in your home currency, which are widely available for major global indices. Tax costs are often the largest overlooked component of investing costs. Capital gains taxes on realized gains, income taxes on dividends, inheritance taxes on investment portfolios. These can significantly erode returns over time. Tax-advantaged account structures exist in most countries specifically to reduce these costs, and using them fully is one of the highest return actions available to most investors. The cost of advice is sometimes worth paying and sometimes not. A genuinely independent financial advisor who charges a transparent fee and provides genuinely personalized guidance can be valuable, particularly in complex situations, inheritance, divorce, approaching retirement, business sale. A commission-based advisor who sells products and charges embedded fees that are not visible to you is unlikely to be providing value commensurate with their cost. Understanding which type of advisor you are dealing with is important. Adding all these costs together, expense ratio, transaction costs, currency costs, tax costs, advisory costs, the difference between a well-structured, low-cost portfolio and a poorly structured, high-cost one can easily be 2 to 3% per year. Over 30 years, the compound effect of that annual difference is very large. Getting the costs right is one of the highest return actions available to any investor, and it requires no market knowledge, no forecasting ability, and no special skill. Just attention to what you are paying and willingness to choose the cheaper alternative when the evidence supports it. News. PAT10, the mental models that actually help. Investing well over long periods requires less information than most people think, and more psychological resilience than almost anyone expects. The mental models that are most useful are not complex analytical frameworks. They are simple ways of thinking about uncertainty, time, and your own behavior that make good decisions more likely and bad decisions less likely. The first useful mental model is thinking in probabilities rather than certainties. Financial markets are genuinely uncertain. Nobody knows what the market will do next year. Nobody knows which sectors will outperform over the next decade. Nobody knows whether the next recession is 6 months or 6 years away. Anyone who claims otherwise is either lying or mistaken. The correct response to genuine uncertainty is not to pretend it does not exist. It is to make decisions that are robust across a wide range of possible futures. A diversified, low-cost index portfolio is robust to uncertainty in a way that a concentrated bet on a specific sector or country is not. It does not depend on any particular economic scenario unfolding. It participates in whatever growth the global economy produces, across whatever form that growth takes. You do not need to be right about the future to benefit from it. You just need to participate and wait. The second useful mental model is thinking about long time horizons in concrete terms. 30 years feels abstract until you count it out. If you are 30 years old, 30 years is the age of your children when they are your age now. If you are 40, it is the age your grandchildren might be when you are gone. The money you invest today will be growing and compounding for longer than most people intuitively grasp. And the decisions you make today, the fees you pay, the behavior gap you create or avoid, will compound for that entire period. This long horizon changes how you should think about short-term events. A 20% market decline over 12 months is terrifying in the moment and essentially irrelevant over 30 years if you maintain your contributions and do not sell. The emotional weight of a short-term decline is inversely proportional to its long-term significance. Training yourself to see short-term events through a long-term lens is one of the most valuable psychological skills an investor can develop. The third useful mental model is the concept of financial resilience versus financial optimization. Most investing content is about optimization, how to get the maximum possible return, how to minimize taxes, how to find the best product. Optimization is valuable, but it is secondary to resilience. A financially resilient person with an emergency fund, no high-interest debt, adequate insurance, and a stable income can withstand almost anything the market or life throws at them without making catastrophic decisions. A financially optimized but fragile person, highly leveraged, no cash buffer. No income stability can be destroyed by a single bad event, even if all their investment decisions were technically optimal. Resilience first, optimization second. The order matters. Part 11. What to do when the market crashes. At some point during your investing lifetime, almost certainly at multiple points, the market will crash. Not might crash, will crash. This is not pessimism. It is the historical record. The S&P 500 has declined more than 20% on multiple occasions in the last 50 years. Declines of 30, 40, 50% have occurred within living memory. The question is not whether you will experience a significant market decline. The question is what you will do when it happens. The financially optimal response to a market crash is to continue your regular contributions. Do not sell, and if you have available cash, consider buying more. This is also the psychologically most difficult response because everything in your emotional environment is telling you to do the opposite. During a significant market crash, the news is uniformly negative. Experts are predicting further declines. Your portfolio value is visibly lower than it was. Your colleagues and social network are anxious. The general sentiment is that things are bad and may get worse. Continuing to buy in this environment requires overriding every social signal around you. It requires genuine conviction in the long-term evidence over the short-term emotional environment. What helps most in these moments is preparation, having thought through in advance what you will do when the market falls, having a written investment policy that you agree to when calm, having an understanding of market history, how every significant decline in history has eventually been followed by a recovery, and how the recoveries have always exceeded the prior peaks over sufficiently long periods. Having an asset allocation that you genuinely can tolerate through a decline. If your portfolio is too aggressive for your actual risk tolerance, you may be forced to sell at the worst time. There is also the practical matter of what a market crash actually looks like in your portfolio. A 40% decline in the value of a 10,000 euro portfolio is a 4,000 euro decline. Significant, but recoverable. A 40% decline in the value of a 500,000 euro portfolio is a 200,000 euro decline, which feels catastrophic even if the long-term trajectory is unchanged. As your portfolio grows, the absolute size of losses in dollar terms increases. Even when the percentage is the same, your emotional response to losses needs to be calibrated to the percentage, not the absolute amount. This is easier said than done, but important to think about in advance. One of the most useful things you can do in advance of the next market crash is to remind yourself of what happened to long-term investors during previous crashes. People who stayed invested through the 2008 financial crisis and did not sell have seen their portfolios recover fully and then significantly exceed their pre-crash levels. People who sold at the bottom of 2008 and waited for things to feel safe before reinvesting largely missed the recovery. The same pattern has repeated after every significant market decline in history. This history does not guarantee the future, but it is the best available guide to how markets behave over long periods. And it is a useful anchor when the present feels unprecedented and terrifying, as it always does during a crash, and as the aftermath always reveals it was not. PAT 12. The role of bonds and alternative assets. We have talked primarily about equities, the global stock market, as the core of a long-term portfolio, but most portfolios include other asset classes, and understanding their role clearly helps you make better decisions about how to allocate your savings. Bonds, fixed income securities, are the most commonly held complement to equities. When you buy a bond, you are lending money to a government or corporation at a fixed interest rate for a fixed period. At maturity, you get your principal back along with the interest payments you have received along the way. Government bonds from stable developed economies are considered among the safest financial assets. The probability of a major government defaulting on its obligations is very low. The role of bonds in a portfolio is primarily stability and diversification. Bonds tend to be less volatile than equities. Their prices fluctuate less, and historically, during periods of significant equity market decline, high-quality government bonds have often performed relatively well or even increased in value, providing a cushion to the overall portfolio. This negative correlation, or at least lower positive correlation, with equities is what makes bonds valuable as a portfolio complement. The trade-off is return. Over long periods, government bonds have historically returned significantly less than equities. The extra return you earn from equities, the equity risk premium, is compensation for the additional volatility and uncertainty of equity ownership. If you hold primarily bonds, you accept lower volatility but also lower expected long-term returns. For investors with very long time horizons, people in their 20s and 30s who will not need the money for 30 or 40 years, the conventional wisdom is to hold primarily equities and relatively few bonds. The long time horizon provides plenty of opportunity to recover from equity market downturns, and the higher expected return of equities compounds significantly over 4 decades. For investors approaching retirement who may need to draw on their portfolio within a few years, bonds provide important protection against a market crash at the worst possible moment, just as you need to sell. Real estate is sometimes held as a third asset class alongside equities and bonds. Owning property directly involves significant costs, illiquidity, and management burden that make it unsuitable as a pure investment for many people. Real estate investment trusts, REITs, allow investment in real estate through publicly traded shares with the liquidity and low cost of stock market investment. REITs are included in global equity indices, so a global index fund already provides some real estate exposure. dedicated REIT allocations are sometimes used to increase this exposure, though the evidence on whether this improves outcomes is mixed. Commodities, gold, oil, agricultural products are sometimes held as inflation hedges or diversifiers. Gold in particular has a long history as a store of value and has provided some protection against extreme financial distress and currency devaluation. The evidence on gold as a long-term investment return generator is weak. It does not produce income, and its price appreciation over very long periods has roughly matched inflation rather than exceeding it. But as a small allocation within a diversified portfolio, some investors find it provides psychological comfort and genuine diversification benefit during specific types of market stress. The honest answer about alternative assets, real estate, commodities, alternatives, is that for most individual investors, a simple two-asset portfolio of global equities and government bonds is probably sufficient. Adding complexity adds costs, decision burden, and opportunity for behavioral error. The diversification benefits of additional asset classes are real but typically marginal for a portfolio that already holds thousands of global equities and a broad bond allocation. More complex is not automatically better, and the evidence for simple portfolios is strong enough that the burden of proof lies with any proposed addition. Part 13. Investing across different life stages. The correct investment approach is not static across a lifetime. As your circumstances change, your income, your family situation, your proximity to retirement, your financial goals, your investment strategy should evolve. Understanding how it should evolve and why helps you make better decisions at each transition point. In your 20s and early 30s, the primary financial priority is building the foundation, emergency fund, eliminating high-interest debt, beginning to invest consistently. The amounts invested are often relatively small because income is typically lower in early career. But this period has the most valuable asset available to any investor: time. Contributions made in your 20s have 40 to 50 years to compound. The mathematical advantage of starting early is enormous, even with modest monthly amounts. The appropriate equity allocation in this stage is high, 80, 90, even 100% for very long time horizons. You can afford to tolerate significant equity market volatility because you have decades for the portfolio to recover from any downturn. And the expected return premium from equities compounds most powerfully over the longest periods. In your mid-30s to mid-40s, career progression typically brings higher income, which allows significantly larger investment contributions. This is often the period of highest income growth and highest savings capacity. It is also often the period of highest fixed cost growth, mortgage, children, lifestyle commitments, so managing lifestyle inflation during this period is particularly important. The additional income from career progression should be at least partially captured for investment rather than entirely absorbed by lifestyle expansion. The investment approach in this stage is broadly similar to the early career stage: high equity allocation, consistent contributions, long time horizon. The main adjustment is beginning to think more specifically about retirement targets and what investment approach will get you there. This is a good stage to calculate what retirement income you actually want, what portfolio size that requires, and what monthly contribution trajectory will reach that target. In your late 40s and 50s, the time horizon is shortening and the equity allocation should begin to gradually reduce. This is not a dramatic shift. moving from 90% equities to 80, then 70, then 60% over a decade. The reasoning is that a significant equity market decline in the 5 years before retirement could materially damage your retirement position in a way that is difficult to recover from. Gradually increasing the bond allocation reduces this sequence of returns risk. The risk that poor returns in the years immediately before or after retirement have an outsized negative impact because you are about to start withdrawing. In retirement itself, the investment challenge shifts from accumulation to drawdown. You need to generate income from your portfolio while also maintaining its purchasing power over what could be a 30-year retirement. The 4% rule, the guideline that a portfolio can sustain withdrawals of 4% of its initial value annually, adjusted for inflation, with a reasonable probability of lasting 30 years, provides a rough benchmark. But it is a guideline, not a guarantee, and individual circumstances vary significantly. The investment approach in retirement typically involves maintaining a meaningful equity allocation, perhaps 40 to 60%, to preserve long-term purchasing power, with sufficient bonds and cash to cover several years of withdrawals without needing to sell equities during a market downturn. This provides a buffer that allows equity market recoveries to happen without forcing withdrawals at depressed prices. Part 14. The complete picture. What good investing actually looks like. Let me close tonight by painting a picture of what good investing actually looks like in practice. Not in theory, not in an optimized model, but in the real life of a real person making real decisions over a real career. It looks like this. You earn money on the day your paycheck arrives, a fixed amount, whatever you have decided you can consistently save, transfers automatically to your investment account. This amount is invested automatically in a global equity index ETF and a government bond ETF, in proportions reflecting your age and time horizon. The investment happens regardless of what the market did last week or what the financial news says this morning. Once a year, you look at your portfolio allocation and rebalance if it has drifted significantly from your target. This takes perhaps 2 hours. For the remaining 363 days, you do not look at your portfolio with any intent to make decisions. You may glance at it occasionally out of curiosity, but you have no standing orders that respond to what you see there. When the market crashes, and it will, you notice that your portfolio is worth less than it was. You feel the loss aversion that is biologically hardwired into you. You read some concerning news, you might talk to colleagues who are selling, and you do nothing. The monthly contribution happens automatically. You do not check more frequently. You do not make any decisions. You wait. When the market recovers, and historically it always has, your portfolio recovers with it and then some. The contributions you made during the downturn bought more shares at lower prices, which have now appreciated. Your patience has been financially rewarded, as it always has been for investors who maintained it through previous downturns. Over 10, 20, 30 years, this process, boring, automatic, patient, requiring almost no ongoing attention, accumulates a portfolio that compounds steadily toward your retirement target. Not because you are clever, not because you picked the right stocks or timed the market, because you started, you automated, you stayed consistent, and you did not let your emotions override your system during the periods when emotions were most intense. That is what good investing looks like. It is not exciting. It does not make for interesting conversations at dinner parties. It does not require any special knowledge or sophisticated analysis. It requires a system, patience, and a discipline to do nothing when everything around you is suggesting that you should do something. The financial industry makes its money from your activity. You make your money from your patience. These incentives are not aligned. Understanding that misalignment and acting accordingly is the most important insight in personal investing. I am not a financial advisor. This is not financial advice. Please do your own research before making any investment decisions. But if someone asked me to describe what the evidence shows about how ordinary people build genuine financial security through investing, this is what the evidence shows. And concretely, what does this add up to over a lifetime? Let me put some numbers to everything we have discussed tonight, because the abstract principles become much more compelling when you see what they produce in concrete terms. Person A and person B both start investing at 30 years old. They both earn the same income. They both save 500 euros per month to invest. Person A puts their money in an actively managed fund, charging 1.5% per year. The fund slightly underperforms the market, as most do. Let us give them a net return of 5.5% per year. Person B puts their money in a low-cost global index ETF, charging 0.2% per year. They earn the market return of 7% per year. After 35 years, at age 65, person A has approximately 680,000 euros. The difference is 320,000 euros from the same monthly contribution over the same period. The only variable is the investment choice and the fee. Now add the behavior gap. Person A, watching an actively managed fund and receiving monthly commentary from their advisor, makes emotional decisions during market downturns, reduces contributions, sells temporarily, reallocates into cash when things are uncertain. This costs them another 1 to 2 percentage points per year in real terms. Person B, with an automated contribution into a boring index fund that they barely look at, makes no emotional decisions. Their contributions continue automatically through every market cycle. After 35 years, adjusting for the behavior gap, person A might have 450 to 500,000 euros. Person B still has approximately 1 million euros. The difference from the same starting point, the same income, the same savings rate is 500,000 euros. From the choice of a low-cost passive approach over a high-cost active approach, and from avoiding the behavioral errors that the active approach tends to generate. This is not a hypothetical constructed to prove a point. These numbers are consistent with the decades of empirical evidence on index investing versus active management, and on the behavioral gap between fund returns and investor returns. The compounding of small differences over long periods produces large differences in outcomes. And the actions that produce better long-term outcomes, low-cost indexing, automatic contributions, behavioral restraint, are available to anyone. Part 15, starting late. What to do if you haven't started yet. A significant number of people who come to personal finance content feel behind. They are 35, 40, 45, and they have not yet built the investment portfolio they feel they should have. They are aware that time is the most powerful variable in compound growth, and they feel the loss of the years they did not invest acutely. I want to address this directly because it is one of the most common sources of financial anxiety, and because the conclusions most people draw from it are not quite right. Starting late is a real disadvantage. This is not something to minimize or dismiss. A person who invests consistently from 25 will, in most realistic scenarios, end up with significantly more money at retirement than a person who starts at 45, all else being equal. The mathematics of compound growth over 20 years versus 40 years is stark. This is true, and it is worth acknowledging clearly. But the conclusions people draw from this recognition are often worse than the starting late itself. They conclude that since they cannot have the optimal outcome, the effort is not worthwhile. They give up before starting, or they delay further while thinking about how to make up for lost time, or they make riskier investment decisions, trying to accelerate the timeline. All of these responses make outcomes worse, not better. The correct response to starting late is straightforward. Start now. Not with some optimal strategy that will make up for lost time, not with higher risk that might produce higher returns, but more likely produces a worse outcome. Just start with the same approach that would have been correct 20 years ago. Consistent contributions to a low-cost global index fund, and accept the outcome that consistent investing from now produces. The outcome from starting at 45 and investing consistently for 20 years is not the same as the outcome from starting at 25, but it is far better than the outcome from not starting at all, and it is better than the outcome from delaying further while looking for a way to make up for lost time. And it is far better than the outcome from taking excessive risks trying to accelerate the timeline, which most often results in significant losses that set the timeline back further. There is also the income angle. People who are starting investment at 45 are typically at a higher income level than they were at 25. The monthly contribution they can make is larger, not so large that it closes the gap with someone who started 20 years earlier and contributed more modestly, but large enough to produce a meaningful outcome over 20 years of consistent investing. The most dangerous response to starting late is the feeling that since you cannot have the optimal outcome, the investment of effort is not worthwhile. This is the sunk cost fallacy applied to the future. The idea that since the past is lost, the future does not matter. It is wrong. The future matters enormously, regardless of the past, and the actions you take now determine the future, regardless of what you did or did not do before. Start now with what you have, with the simplest approach that the evidence supports, and continue consistently. Part 16: Savings Rate v. Investment Return. Which one matters more? Here is something that most personal finance content gets subtly wrong. It focuses heavily on investment returns. Which ETF to buy, how to minimize fees, how to optimize asset allocation, while giving much less attention to the variable that matters most in the early and middle stages of building wealth: your savings rate. The savings rate is the percentage of your income that you save and invest. And in the early stages of wealth building, when your portfolio is small relative to your income, the savings rate completely dominates investment returns as a driver of outcomes. Consider two people. Person A saves 10% of their income and earns 8% annual returns. Person B saves 20% of their income and earns 6% annual returns. Despite the worse returns, Person B will typically build wealth faster in the first 15 to 20 years because the larger contribution overwhelms the return difference. This changes over time. As the portfolio grows and compound growth becomes more powerful, investment returns matter increasingly. A person with a 500,000 euro portfolio will see the annual returns of 7%, 35,000 euro, significantly exceed what they can add from savings. At that point, the portfolio dynamics are dominated by investment returns rather than contributions. But in the early and middle stages, the first 10 to 20 years for most people, the savings rate is the primary lever. This is worth knowing because it redirects attention appropriately. If you are 30 years old with a 40,000 euro portfolio, spending significant mental energy optimizing your portfolio allocation is less valuable than finding ways to increase your monthly contribution by 200 or 300 euros. The savings rate is also more controllable than investment returns. You cannot control what the market does. You cannot reliably find investments that outperform the market, but you can control how much of your income you direct to investment. You can reduce expenses, you can increase income. You can direct income increases to saving before lifestyle inflation absorbs them. These actions directly determine the savings rate, which directly determines wealth accumulation in the early stages. The most efficient allocation of financial attention for someone in the early stages of building wealth is probably something like 70% on income growth and expense management. The factors that determine savings rate and 30% on investment decisions. Most people get this backwards, spending most of their financial attention on investment product selection while paying much less attention to the income and expense fundamentals that matter more. Part 17, Market Timing. Why it doesn't work and what to do instead. Market timing is the strategy of moving in and out of investments based on predictions about where the market is heading. Buy before it goes up, sell before it goes down. It sounds logical. It is extremely appealing because it seems like it should be possible to do better than simply buying and holding. The evidence on market timing is uniformly negative. Studies consistently show that individual investors who attempt market timing produce worse outcomes than those who simply buy and hold. Professional market timers, hedge funds, tactical asset allocation funds also fail to consistently add value through timing, net of the fees they charge and the transaction costs they generate. Why is timing so difficult? The market incorporates information extremely quickly. By the time a piece of information is widely known, by the time you have read about it in the news and formed a view about its implications for the market, professional investors have already acted on it. The price already reflects the information. You are not trading on an insight, you are trading on yesterday's news. There is also the asymmetry problem we discussed earlier. The best days in the market tend to cluster around the worst days. If you exit the market during a decline and wait for stability before reinvesting, you are very likely to miss some of the best days. And missing just a handful of the best days over a decade has an enormous negative impact on your returns. Market timing also generates transaction costs, tax events, and emotional energy that have real costs without producing the benefits they promise. The decision to time the market requires two correct decisions: when to exit and when to re-enter. Both must be timed correctly to add value. The probability of consistently making both decisions correctly over many market cycles is very low. What to do instead is simply the approach we have discussed throughout tonight. regular automatic contributions regardless of market conditions. Patience through market downturns. Rebalancing on schedule rather than in response to market movements. A simple, low-cost, broadly diversified portfolio that does not require ongoing judgment about market direction. This approach does not feel as active or as intellectually engaging as market timing. It does not give you interesting things to discuss with people who talk about markets, but it produces better outcomes. And outcomes are the only thing that matters. Part 18. How much is enough? The retirement number. Nobody calculates. There is a question that sits underneath all of personal finance that most content does not answer clearly. Not how to invest, not which fund to choose, not how to optimize taxes. The more fundamental question, how much do I actually need? The answer depends on two things: how much you want to spend in retirement and how long your retirement is likely to last. Both are uncertain, but both can be estimated. Start with the first question. What monthly income do you actually want in retirement in today's money? Not what you think you should want, what you actually want, the lifestyle you would genuinely find comfortable and fulfilling. For many people, this is surprisingly similar to what they spend now. Minus the costs associated with working, commuting, work clothes, lunches, out, and minus the mortgage if it will be paid off by retirement. Take that monthly figure, multiply by 12 to get your annual income requirement, and then apply the 4% rule. The 4% rule suggests that a well-invested portfolio can sustain withdrawals of 4% of its initial value annually, adjusted for inflation, with a reasonable probability of lasting 30 years. This is a guideline, not a guarantee. It is based on historical returns and does not account for all possible scenarios. But it is the most widely used benchmark and gives you a useful starting point. If you want 2,000 euros per month in retirement, 24,000 euros per year, the 4% rule implies a portfolio of 600,000 euros. If you want 3,000 euros per month, 36,000 euros per year, the implied portfolio is 900,000 euros. These numbers may feel large or small depending on your current situation and income. The point is not to be discouraged by them, but to make them concrete. A concrete target is far more useful than a vague aspiration to save more. It tells you exactly what monthly contribution rate, invested at what return, over what time period, gets you to your target. And it allows you to make explicit trade-offs between retiring earlier and retiring with more, between spending more now and saving more for later, between working longer and contributing less. The calculation also reveals the power of the savings rate and timeline in a very concrete way. Someone who saves 500 euros per month at 7% return for 35 years reaches approximately 1 million euros, comfortably above the 900,000 euro target for 3,000 euros per month in retirement. Someone who saves 300 euros per month for the same period reaches approximately 600,000 euros, comfortably at the 600,000 target for 2,000 euros per month. Modest monthly contributions invested patiently over decades produce retirement outcomes that are genuinely life-changing. On financial independence, what it actually means and why it matters. Financial independence is a term that has become associated with the FIRE movement. Financial independence, retire early, and with a specific approach to aggressive saving and early retirement. But the underlying concept is valuable far beyond any particular movement or lifestyle choice. Financial independence, in its most useful sense, means having enough invested assets that you no longer depend on employment income to cover your living expenses. Your portfolio generates enough return through dividends, growth, or drawdown to fund your lifestyle without needing to work. This is meaningful not just because it enables retirement, it enables a fundamentally different relationship with work and career choices. When you are financially independent or approaching financial independence, you can take career risks that would be impossible if you depended on your paycheck. You can leave a job that is making you miserable without immediately needing another one. You can pursue opportunities with lower immediate income but higher potential. You can say no to things you do not want to do. Financial independence is not primarily about not working. Most people who reach genuine financial independence continue to work in some capacity, because work provides meaning, structure, social connection, and intellectual engagement that money alone does not. But they work because they choose to, not because they have to. And that distinction changes everything about the experience of work. The path to financial independence is exactly the path we have discussed tonight. Consistent investing in low-cost index funds, maintaining a high savings rate, living below your means, avoiding the expensive mistakes of high-cost products and behavioral errors. Nothing exotic, nothing clever, nothing that requires exceptional skill or unusual access. Just consistent, patient application of the principles that the evidence supports. The timeline depends on your savings rate more than almost anything else. Someone who saves 10% of their income and invests it well will take roughly 40 years to reach financial independence. Someone who saves 20% will take roughly 30 years. Someone who saves 40% will take roughly 20 years. The savings rate is the primary variable, more than investment returns, more than income level, more than any product choice. This is both daunting and empowering. Daunting because it requires sustained discipline over long periods. Empowering because it is something you control directly. You cannot control the market. You cannot always control your income, but you can control the gap between what you earn and what you spend. And that gap invested consistently is the engine of financial independence. That is everything for tonight. A lot of ground covered, from the basic evidence on index investing to dollar cost averaging, portfolio construction, diversification, rebalancing, the order of operations, and the bigger picture of what good investing looks like over a lifetime. The thread running through all of it is the same. Simple is better than complex, automatic is better than discretionary, patient is better than active, low cost is better than sophisticated. And the evidence for these principles is so consistent across so many markets and time periods that the burden of proof lies heavily on anyone proposing an alternative. You do not need to be clever to invest well. You need to be consistent, patient, and resistant to the impulses that the financial environment and your own psychology will reliably generate. The system does the work. Your job is to set it up, automate it, and then mostly leave it alone. Part 19. Financial independence, what it really means. Financial independence is a term that has become associated with the FIRE movement. Financial independence, retire early, and with a specific subculture of aggressive saving and very early retirement, This association has caused many people to dismiss the concept as extreme or unrealistic. But the underlying idea is valuable far beyond any particular lifestyle choice or movement. Financial independence in its most useful sense means having enough invested assets that you no longer depend on employment income to cover your living expenses. Your portfolio generates enough return through growth, dividends, or controlled drawdown to fund your lifestyle without needing to work. Not necessarily without working, without needing to. That distinction between working because you choose to and working because you have to is one of the most significant differences in quality of life that money can create. And it does not require extreme wealth. It requires a portfolio large enough to cover your expenses at a sustainable withdrawal rate, which for most people in developed countries is reachable over a normal working career with reasonable savings discipline. The reason this matters beyond retirement is that financial independence creates options. When you are financially dependent on your paycheck, when losing your job would quickly exhaust your savings and create serious hardship, your range of choices is severely constrained. You cannot easily leave an employer who treats you badly. You cannot easily take a risk on a career change or a business idea. You cannot easily take time off for family health or personal reasons. Every major life decision is filtered through the question of whether you can afford it right now, with your current income and your current savings. When you are financially independent, or even partially financially independent, with savings that could sustain you for a year or two without income, the options expand significantly. You can take risks you would not otherwise take. You can say no to things that do not serve you. You can prioritize things that matter more than income. The financial security creates a kind of optionality that has enormous value in the actual experience of living. The timeline to financial independence is primarily determined by your savings rate. This is worth making explicit because it gives you direct control over the timeline in a way that return optimization does not. If you save 10% of your income starting from zero, you will reach financial independence in approximately 40 to 45 years, a normal retirement age for most people who start their careers in their 20s. If you save 20%, the timeline compresses to roughly 30 to 35 years. If you save 30%, roughly 25 years. 40%, roughly 20 years. 50%, roughly 17 years. The higher savings rates require significant lifestyle choices, living more modestly than your income would allow, or earning significantly more than average, or both. For most people, a savings rate of 15 to 25% represents the practical range that is ambitious but genuinely achievable, and a savings rate in that range maintained consistently over a 30-year career produces a genuinely transformative outcome. The key insight is that the savings rate is more controllable than almost any other variable in the financial independence equation. You cannot control market returns. You cannot always control your income trajectory, but you can control the gap between what you earn and what you spend. And that gap, invested consistently in low-cost index funds, is the engine of financial independence. Part 20. The mistakes most new investors make. Let me be specific about the most common and most expensive mistakes that people make when they first start investing. Not because you are necessarily about to make them, but because knowing them in advance makes them easier to recognize and avoid when you encounter the pressure to make them. The first and most common mistake is waiting for the right time to start. The logic feels sound. Surely it is better to invest when the market is lower rather than higher. If you wait for a correction, you will get in at better prices. The problem is that nobody knows when corrections are coming, and the attempt to wait for them keeps people out of the market for months or years, during which the market may continue to grow. Studies consistently show that the expected cost of waiting for a better entry point exceeds the expected benefit of buying at a temporarily lower price. The best time to invest was yesterday. The second best time is today. The second mistake is investing money you cannot afford to lose in the relevant time horizon. The stock market can decline significantly and remain low for several years. If you invest your house deposit, your emergency fund, or money you will need within 3 to 5 years, and then need it during a market downturn, you will be forced to sell at a loss. Investment capital should be money you genuinely will not need for at least 5 to 10 years, ideally much longer. Any money you might need sooner belongs in a savings account or short-term bonds, earning less but accessible without risk of loss. The third mistake is confusing recent performance with expected future performance. An asset that has performed well for the last 3 years attracts investors who believe this performance will continue. In reality, short-term performance has very limited predictive power for future performance. Buying after strong recent performance typically means buying at elevated valuations, which implies lower expected future returns, not higher. The correct response to seeing that a sector or fund has done extremely well recently is caution, not enthusiasm. The fourth mistake is over-concentrating in familiar names. People invest heavily in companies they know, their employer, the brands they use, companies they read about frequently. This creates concentrated exposure to a small number of companies when broad global diversification would produce better risk-adjusted outcomes. Familiarity is not investment merit, and the most widely known companies are typically the most efficiently priced, meaning there is likely the least opportunity for outperformance in the companies you follow most closely. The fifth mistake is using leverage without fully understanding its implications. Borrowing to invest, using leveraged products, investing on margin, taking loans to invest, amplifies both gains and losses symmetrically. In a rising market, leverage looks clever. In a falling market, it can be catastrophic. The risk of losing more than your initial investment and of being forced to sell at the worst possible time to meet margin calls. For most retail investors, avoiding leverage entirely is the correct approach. The expected return improvement from leverage does not justify the tail risk for someone building long-term wealth. The sixth mistake is mistaking activity for progress, making frequent changes to your portfolio, switching funds, adjusting allocations in response to news, experimenting with different approaches feels productive. It feels like active stewardship of your financial future. In reality, most portfolio changes reduce outcomes through transaction costs, tax events, and the behavioral errors that typically drive the changes in the first place. The correct approach requires doing less than feels natural. The discipline to maintain the system rather than constantly adjusting it is one of the hardest skills in investing and one of the most valuable. PAT 21. The tax dimension and often ignored sources of returns. We have talked about fees extensively because they are one of the most consistently overlooked sources of return destruction. But there is a second dimension that deserves its own section: taxes. And specifically, the gap between the tax burden most people carry on their investments and the tax burden they could carry with better structuring. Investment returns are taxed in most countries. Capital gains, the profit from selling an investment at a higher price than you bought it, are taxed when you realize them. Dividends paid by stocks or funds are typically taxed as income in the year they are received. Over a long investment horizon, these taxes compound in a way that significantly reduces final wealth relative to what it would have been in a tax-free environment. The magnitude of this effect is often underestimated. If your portfolio generates 7% annual returns and you pay tax on those returns each year at a 30% effective rate, your effective annual return after tax is closer to 5%. Over 30 years, the difference between 5 and 7% annual returns on a €100,000 portfolio is enormous. Roughly the difference between €400,000 and $800,000. The tax reduces your ending wealth by nearly half. This is why tax-advantaged account structures are so valuable, and why using them first is part of the correct order of operations. In France, the PEA allows equity investment gains to escape income tax after a 5-year holding period, with only social charges applied. In the UK, the ISA allows completely tax-free growth and withdrawal, with no tax at any stage. In the US, the Roth IRA allows after-tax contributions to grow and be withdrawn entirely tax-free. Similar structures exist in most developed countries. These accounts do not change what you invest in. You can hold the same global index ETFs inside a tax-advantaged account as outside one. They change only the tax treatment of your gains. And this tax treatment difference, compounded over decades, is one of the largest available sources of additional return that requires no investment skill, no market insight, and no additional risk-taking. The second dimension of tax efficiency is minimizing taxable events within your portfolio. Every time you sell an investment at a profit in a taxable account, you trigger a capital gains tax liability. Frequent trading generates far more taxable events than long-term buy and hold investing. This is another reason why the passive, low-turnover approach of index investing is superior. Index funds have low portfolio turnover, which minimizes the taxable events they generate, compared to actively managed funds that buy and sell frequently in their pursuit of outperformance. The third dimension is the choice between accumulating and distributing funds. Accumulating funds reinvest dividends automatically within the fund, rather than distributing them to you. This means no taxable dividend event each time dividends are reinvested, which can be more tax efficient depending on your country's tax treatment. In practice, the most tax-efficient approach depends on your specific situation and jurisdiction. This is an area where country-specific guidance from a qualified advisor adds genuine value. Tax efficiency does not require complex structures for most individual investors. It requires using available tax-advantaged accounts to their full capacity first, minimizing unnecessary trading and the taxable events it creates, and choosing fund structures that minimize visible dividend distributions where appropriate. These steps, applied consistently, can add the equivalent of 1 to 2 percentage points per year in after-tax return, a significant addition to long-term wealth that requires no additional risk. Part 22. Investing and Inflation. The complete picture. We discussed inflation earlier in this series, as a threat to cash savings. But the relationship between investing and inflation is worth examining more carefully, because understanding it clearly helps you evaluate whether your investment approach is actually protecting your purchasing power or simply creating the appearance of doing so. Inflation erodes purchasing power over time. Something that costs 100 euros today will cost roughly 200 euros in approximately 30 years at 3% annual inflation. This means that a portfolio that grows from 100,000 euros to 200,000 euros over 30 years has not actually grown in real terms. It has kept pace with inflation. Real wealth growth requires returns that exceed inflation, not just returns that are positive in nominal terms. The good news is that a globally diversified equity portfolio has historically produced returns well above inflation over long periods. The S&P 500 has returned approximately 10% per year in nominal terms over the last century, roughly 7% in real, inflation-adjusted terms. Equities represent ownership of productive businesses, and productive businesses have historically increased their revenues and profits at rates that outpace inflation. When prices rise broadly, the revenues and profits of the companies you own tend to rise with them. This is the fundamental mechanism through which equity ownership provides inflation protection over time. Bonds are more complicated. Traditional fixed-rate government bonds have a specific vulnerability to inflation. Their future payments are fixed in nominal terms, which means their real value declines as inflation rises. A bond that pays 2% interest when inflation is 1% generates a real return of approximately 1%. The same bond, when inflation rises to 4%, generates a real return of negative 2%. This is why bond portfolios can lose real value during periods of high inflation, as investors learned dramatically in 2022 when inflation spiked and bond prices fell sharply across most developed markets. Inflation-linked bonds whose principal and interest payments are adjusted for changes in the price level provide better inflation protection than fixed-rate bonds. Including some allocation to inflation-linked bonds within a fixed income allocation reduces this vulnerability, though at a cost in real return expectations during normal, lower inflation environments. Real assets, property, commodities, infrastructure have historically provided inflation protection because their values tend to rise with the general price level over time. Property values and rental income tend to increase with inflation. Gold is often cited as an inflation hedge, though its inflation protection properties are inconsistent over shorter periods, and its expected real return over very long periods is approximately zero. It preserves purchasing power rather than growing it. Broad equity exposure through a global index fund already provides indirect exposure to commodity producers and real estate investment trusts, which are included in global equity indices. The practical conclusion for a long-term investor is that maintaining a meaningful equity allocation, the globally diversified index approach, is the most straightforward and most evidence-supported approach to inflation protection available to an ordinary investor. Equities have outpaced inflation over every major long-term period in modern financial history. The protection is not perfect and not immediate. Equities can underperform inflation over short periods of years, but over the time horizons relevant to retirement savings, equity ownership has reliably preserved and grown real purchasing power in ways that cash, savings, and fixed-rate bonds have not. Part 23. Bringing it all together, the investor you want to be. Let me close tonight by describing the investor you are trying to become. Not the most sophisticated investor, not the most active, the most effective, the one whose behavior over decades produces the best real outcomes. This investor has clarity about their goals. They know their retirement income target. They know roughly how many years they have to reach it. They know what monthly contribution at what expected return over that period gets them there. Their financial decisions are made in the context of this clarity rather than in response to short-term noise. This investor has a simple portfolio, a global equity index ETF, a government bond ETF, in proportions reflecting their age and risk tolerance, held in tax-advantaged accounts to the extent available. The simplicity is a deliberate choice based on the evidence that simple, low-cost, broadly diversified portfolios produce outcomes that match or exceed more complex alternatives net of all costs. This investor contributes automatically. On payday, every month, a fixed amount transfers from their bank account to their investment account and is invested in their chosen funds. The contribution is automatic. It requires no decision in the moment and is not influenced by market conditions, news, or emotional state. The amount was decided when clear-headed and continues regardless of how things feel in any given month. This investor rebalances annually. Once a year, they spend 2 hours reviewing their portfolio allocation and returning it to target if it has drifted significantly. For the remaining 363 days, they do not make portfolio changes. They may look at their portfolio occasionally out of curiosity, but they do not act on what they see outside of the annual review. This investor manages their behavior through systems rather than willpower. They do not rely on being emotionally strong enough to resist panic selling. They have automated their contributions so that selling is an active choice requiring deliberate effort. They do not rely on being wise enough to resist FOMO. They have a written investment policy that reminds them of what they decided when calm. They do not rely on being disciplined enough to save. They have automated savings so that spending those savings requires an active override. This investor has the right time horizon. They measure success over decades, not months. A down year in the market is not a setback. It is an expected fluctuation and a journey measured over 30 years. The emotional weight they assign to short-term market movements is proportional to their actual financial significance over that time horizon, which is very small. This investor is humble about what they know and do not know. They do not believe they can predict market movements. They do not believe they can identify the next outperforming sector or the next undervalued stock. They do not act on financial media commentary as if it provides actionable investment insight. Their confidence about investment prediction is accurately calibrated, which means very low, and their approach is designed accordingly. This investor understands costs completely. They know their fund expense ratios, they know their platform fees, they know their tax-advantaged structures. They choose the lowest cost available option that meets their needs, because they understand that fees compound against them in exactly the same way that returns compound for them, invisibly, relentlessly over decades. And this investor is patient, not passively patient, not simply waiting without thought. Actively patient, choosing not to act when every emotional signal suggests action, recognizing the feeling of urgency as a signal to be more cautious rather than less. Understanding that the value of patience compounds over time in exactly the way that money does. I am not a financial advisor. This is not financial advice. Please do your own research before making any investment decisions. But if someone asked me to describe what good investing looks like across a lifetime, what the evidence supports, what the data shows, what actually produces the best real outcomes for ordinary people investing ordinary amounts over normal careers, this is what it looks like. Simple, automatic, patient, low cost, long term, and mostly boring. Boring is fine. Boring works. PAR2 2018. How to talk about money without being misled. Here is something that does not appear in most personal finance content, but that I think is genuinely useful. Most conversations about investing that most people encounter at work, with family, with friends, contain significant amounts of misleading information presented confidently by people who genuinely believe they are being helpful. Understanding the common patterns of misleading investment conversation helps you recognize when you are receiving advice that sounds authoritative but may not be. Not because people are dishonest, they are usually completely genuine. But because investment narratives spread through social networks in ways that preserve the exciting parts and quietly discard the important qualifications. The first pattern is the survivorship story. Someone tells you about an investment that made them a significant return. They bought a specific stock before it ran up, or invested in crypto at exactly the right moment, or sold property at the peak. What this story typically does not include, what the storyteller may not even consciously register, is the investments that did not work, the ones that lost money, the lucky timing they had no particular insight to predict. Investment success stories circulate far more widely than investment failure stories. The resulting picture of the investment landscape is systematically distorted toward exciting successes and away from ordinary failures. The second pattern is the hot tip. Someone tells you about an investment opportunity that is particularly promising, a company about to announce something big, a sector poised to run, a market that is currently undervalued. Hot tips create urgency and the feeling of inside information. In reality, any information being discussed in social settings has already been processed by millions of sophisticated investors with far more resources and much better information access. It is already in the price. Acting on a hot tip that has circulated socially is almost always paying a premium for yesterday's opportunity. The third pattern is complexity as a signal of sophistication. Someone describes a complex investment approach, a particular technical analysis system, a systematic options strategy, a rotation between asset classes based on economic signals. That sounds more sophisticated than simply buying an index fund. The complexity creates the impression that careful thinking will produce better results. In most cases, the sophisticated strategy performs worse than the simple approach net of fees. And after accounting for execution costs, in investing, complexity tends to add costs and opportunities for error without adding commensurate return. Being aware of these patterns does not mean you should never discuss investing with other people. It means receiving investment conversations the way you should receive most information, with appropriate skepticism, with awareness of what incentives might be shaping the message, and with the willingness to check claims against the evidence rather than accepting them at face value. The most valuable thing you can bring to any investment conversation is the simple question: what does the large-scale, long-run evidence actually show? Not what seemed to work once, not what sounds compelling right now, not what someone experienced in one specific instance. The consistent, repeatable, decades-long evidence, and that evidence on the major investment decisions is not ambiguous. Low-cost passive investing outperforms most alternatives most of the time over long periods. That is the evidence. Everything else, however confidently delivered, is narrative. Sleep well.